Hello, welcome from Trend Signal for our review of the data and events the week beginning the 9th of November. We start the week following on from some extraordinarily strong non-farm payroll data or employment data from the United States. Effectively, this data, a release of 271,000 in October, a lot better than expected. It suggests that this rate decision now becomes a lot clearer for the Federal Reserve in December, and there are clear expectations now for a rise of 0.25%. The US economy appears to have achieved what the Fed describes as escape velocity, implying that the economy can withstand higher rates. Still no inflation, but the Fed's keen to raise rates and start the normalization process, normalization of rates, which have been at historic lows since the middle of the financial crisis. In fact, rates were last raised in June 2006, so that's 9.5 years ago, which is pretty unprecedented. And the last movement in rates was the cut on December the 16th, 2008, when rates were cut from 0.5% to 0 to 0.25%. Since 2008, the Fed has kept its benchmark interest rate at this rate of 0 to 0.25%. And the move then was announced in the gloom of that big recession, the longest recession since World War II, when the jobs market was collapsing as workers were laid off in the face of a collapse in the financial system. 10 days actually before rates were cut in December 2008, the government announced its payroll data and stating that the number of jobs shrank by 533,000 in the previous month, which is the largest one-month loss since 1974. And actually, they did revise that even worse to a loss of 765,000 jobs in 1 month. So you can imagine the gloom that was surrounding the markets at the time. Anyway, that was then, now is now. Things have moved on a lot, obviously. Markets last week, FTSE was flat, the US markets were up, the DAX was up about 1.9%. The Nikkei responding to a weaker yen, as indeed the DAX was responding to a weaker euro, in fact. But other than that, the big event last week, or the reaction to the big event, the non-farm payroll, was a substantial rally in the US dollar. Against the euro, it rallied about 2.6 cents. Against sterling, which is already weak following Super Thursday and some of the comments from Mark Carney about interest rate expectations. Sterling fell 3.75 cents versus the dollar, so a significant move. Not just there though, the yen, that's fallen quite sharply, fell about 2.5 yen to the dollar following non-farm payroll last Friday. So it's across the board, really, and it looks as if the dollar will probably continue to rally. A number of forecasts, not least from Goldman Sachs, commenting on the fact that we could see euro dollar trading around 105 ahead of the ECB December meeting, and at 0.95 in 12 months' time, so falling through parity, and it'll probably go further than that, I suspect. Bond yields spiked on the back of it. No inflation at the moment, but yields did rise sharply as markets priced in higher short-term rates. All treasuries yields rallied last week as bond prices fell. In fact, all 10-year bonds fell sharply in all the major markets, really, in reaction to this very strong US employment data. Equity markets, well, they did fall initially in pretty volatile trade, but by the close on Friday night, most US indices were higher as markets almost seemed to embrace the expectation of higher rates. But what happens next is the tough one. We do need to get the FOMC meeting in December out the way. There is a significant majority now expecting a rate rise of 0.25%, but it's what happens after that, of course, and that's when the markets will start to look at what the path of interest rates will be. In fact, there's an article in the Financial Times about the pace of rate liftoff. So as soon as we get one hike, expectations will start to center around when the next hike will occur, etc., etc. Let's have a look at the data and events this week. Obviously, following on the seismic shifts in the markets last week and the non-farm payroll, this week is noticeably quieter, obviously. There's quite a bit of focus on Chinese data with inflation data out on Tuesday, CPI data in China, and other indicators out on Wednesday. We've also got industrial production. And there is a view that it might be starting to stabilize a little bit in China, although the market still remains pretty nervous. Other than that, we've got our employment data here in the UK, but the week is really characterized by a number of speeches and comments from central bankers, as has been over the last month, really. They seem to be ruling the roost, quite frankly. We got Mark Carney, the Governor of the Bank of England, on Tuesday. Then in the afternoon, we have Mario Draghi, Super Mario, the President of the European Central Bank, also talking. And we have a number of Fed FOMC members as well speaking. So it's one of those weeks after the storm. It is expected to be a little bit quieter, certainly on the data and event side of things. Probably the most important day of the week in terms of data is Friday, where we have prelim data on European GDP, which is expected to tick up slightly. Certainly that's the expectation. Then we have the retail sales data out in the States, which the core one, which is without automobiles and gasoline, so it's less volatile. It's the core number that we're looking at. We're expecting a rise of 0.4%. And also the preliminary reading from the University of Michigan Consumer Sentiment is also an important indicator. We had quite a revision down the previous month, but we're expecting an uptick in sentiment. And of course, this may well take into account the non-farm payroll data from last Friday. So it could be that that comes out even a little bit stronger than a 91.3, despite the fact that we have an interest rate hike looming on the horizon. The US consumer remains quite buoyant. That's it for now. Thank you very much for listening. Bye for now.
If you would like more information about trading the right way, Trend Signal is giving you the opportunity to see and hear about its services live at a free online seminar. Take a look at the Trend Signal website for the latest events and to book your free place.